In this example, goods or services are contributed by the customer. Now, when you look at our steps, you will identify that this will fall within step 3, where we need to determine our transaction price, and this will be our non-cash considerations at fair value. Now, let's read through the information provided. Q Limited enters into a contract with its customer to build a bottling machine for its new brewery. The contract price is 2 million, excluding any materials purchased by the customer, and over which Q Limited will have control. The contract meets the criteria in terms of paragraph 9, and then in terms of the contract between the parties, the customer will purchase all of the materials and have them transported to Q Limited's premises. Q Limited will obtain control over these materials when they are delivered to Q Limited's premises. The fair value is 520,000. Now, my recommendation, if there is a scenario that you are struggling to identify within your principles, include a picture to ensure that you understand the flow of the transaction. We know that there is a contract between these two entities, and they've indicated to us the transaction price of our contract is 2 million. But important that this exclude the material purchased by the customer. They indicate to us that our customer will purchase the material, and this will be delivered to the premises of Q Limited, and Q Limited will obtain control of these materials. Now, how do we account for the 520,000 fair value of our material into our transaction? What is the total revenue that Q Limited can recognize? We will have to include the fair value into our total transaction price. Therefore, the total revenue will be 2,520,000 that Q Limited can recognize. Remember, we will have to include this at fair value. If our fair value is not available, we can use our standalone selling price.